Welcome, everyone. As investors and strategic partners, you are constantly scanning the horizon for opportunities that promise growth. But how do we define success in a world of varying risks? The answer lies in the weighted average cost of capital, or WACC. It is more than just a finance formula. It is the minimum acceptable return a company must earn on its existing asset base to satisfy its creditors, owners, and other providers of capital. Think of WACC as the hurdle rate, the bar a company must clear to truly create value. Today, we will break down how WACC is calculated and why it is the most critical benchmark for evaluating high-growth firms and potential acquisitions. The first major pillar of WACC is the cost of equity. Unlike debt, equity doesn't have a fixed interest rate. Instead, it represents the return shareholders require for taking on the risk of ownership. We calculate this using the Capital Asset Pricing Model, or CAPM. This formula starts with the risk-free rate, typically a 10-year Treasury yield, and adds a premium based on the stock's beta. Beta measures how volatile the company is relative to the broader market. If a startup has a beta of 1.5, it is 50% more volatile than the market, requiring a higher return to justify your investment. Understanding this helps us price the risk inherent in high-growth ventures. The second pillar is the cost of debt. For mature firms, this is often the interest rate on their bonds or bank loans. However, debt has a unique advantage. Interest payments are tax-deductible. This creates what we call a tax shield, effectively lowering the true cost of borrowing. If a company borrows at 6% and has a 25% corporate tax rate, the after-tax cost of debt is only 4.5%. This is why many firms use leverage to optimize their capital structure. However, as investors, we must monitor this closely. While debt is often cheaper than equity, excessive leverage increases the risk of financial distress, which can eventually drive the total WACC back up. Once we have the costs of equity and debt, we must determine their relative weights. A common mistake is using the book value from the balance sheet. To get an accurate WACC, we must use the market value of the firm's capital. This means looking at the current share price multiplied by shares outstanding for equity and the current market price of debt. If a company is 70% equity funded and 30% debt funded, those are the weights we apply. The goal is to reflect the current market reality, not historical accounting data. This weighting ensures that our WACC reflects what it would actually cost the firm to raise new capital today. Now, let's put the pieces of the puzzle together. The WACC formula is the sum of the weighted cost of equity and the weighted after-tax cost of debt. By multiplying the cost of each component by its proportional weight, we arrive at a single percentage. This number tells us the average cost the company pays for every dollar it finances. For a VC evaluating a startup, a high WACC might indicate a risky bet in a volatile sector, whereas a lower WACC might signal a stable, cash flow positive business. This single percentage is the anchor for all our subsequent valuation models, including discounted cash flow analysis. Why does WACC matter for your investment strategy? It serves as the ultimate filter. When a company considers a new project, acquisition, or R&D investment, it calculates the internal rate of return, or IRR. If the IRR is higher than the WACC, the project creates value for shareholders. If it's lower, the project destroys value, even if it's technically profitable. For you as an investor, WACC helps you determine if the management team is being disciplined with your capital. It is the benchmark against which all strategic decisions are measured. A firm that consistently generates returns above its WACC is a compounding machine that builds long-term wealth. It is important to remember that WACC is not static. It changes as market conditions evolve. If the Federal Reserve raises interest rates, the risk-free rate goes up, and consequently, the cost of both debt and equity rises. If the market becomes more volatile, betas may increase. As investors, we perform sensitivity analysis to see how a 1% change in WACC affects the company's valuation. In a high interest rate environment, valuations naturally compress because the cost of capital is higher. Understanding these sensitivities allows us to stress test our investment thesis and prepare for different economic cycles. In conclusion, the weighted average cost of capital is the heartbeat of corporate finance.
For potential investors and VCs, it provides a clear mathematical lens to view risk and reward. By mastering WACC, you can identify which firms are truly generating economic profit and which are simply treading water. As you evaluate your next high-growth opportunity, ask yourself, does this team understand their cost of capital? And more importantly, do they have a clear path to exceeding it? Thank you for your time, and we look forward to discussing how these principles apply to our current portfolio opportunities.